A war thousands of miles away, a stock market in an absolute freefall. So how does that happen? Today on The Explainer, we're connecting the dots to show you how a conflict in the Middle East managed to wipe out over 9 trillion rupees from the Indian economy in a single day. Let's dig in. Just look at that number, 9 lakh crore rupees. That's how much investor wealth just vanished from the Indian stock market. And we're not talking about over a year or even a month. This happened in one single day, March 30th, 2026, a 9 trillion rupee shockwave.
So the big question is, how is that even possible, right? How can military action happening on one side of the planet cause such complete financial carnage on the other? Well, the answer is a chain reaction, a series of dominoes that just fell one by one, leading to a total market meltdown.
Okay, so let's start with the damage report. Let's look at the crime scene itself, because the numbers from March 30th show a market that wasn't just dipping, it was in a complete nosedive. I mean, you can see just how widespread the sell-off was. The big benchmark indices, the Sensex and the Nifty 50, they both dropped by over 2%. But look closer at the Nifty Bank Index. It was absolutely hammered, down almost 4%. That's a huge red flag, right? It tells you that the financial sector was really at the epicenter of the shock. And you know, this wasn't some orderly retreat. This was pure, unadulterated panic. The India VIX, which is basically the market's fear gauge, it just went through the roof. A spike like that means only one thing: intense, widespread uncertainty, with investors all scrambling for the exits at the exact same time. So, what lit the fuse? What caused all this panic? Well, for that, we need to shift our focus away from the stock market tickers and zoom out, way out, to the geopolitical map of the Middle East. The trigger was a sudden, dramatic escalation in the US-Iran conflict. You know, it had been simmering for about 5 weeks, and then suddenly, things just exploded. The US sent in more troops, Houthi forces launched their first direct attacks on Israel, and then came the big one. The US threatened to go after Iran's key oil infrastructure. The conflict was officially boiling over. And all of this action, it all centers on one tiny but incredibly critical location, the Strait of Hormuz. Think of this narrow waterway as the world's most important oil pipeline. You threaten the 20% of all global oil that flows through there, and you send a massive shockwave of fear through every single market on the planet. And all that fear? It had an immediate, real-world impact on one critical number that affects all of us: the price of crude oil. Just look at this spike. It tells the whole story. Before the war, Brent Crude was pretty stable, hovering around $70 a barrel. By March 30th, it had skyrocketed past $115, a level we hadn't seen in years. This wasn't a gradual climb. This was a vertical leap, fueled by pure geopolitical fear. So why does this matter so much for India? Well, it's pretty simple. India is one of the world's biggest importers of oil. So a price spike like this isn't just a news headline. It's a direct blow to the economy. It means higher inflation, a bigger trade deficit, and rising costs for absolutely everything, from transportation to manufacturing. But here's the thing. This oil shock wasn't a single event. It was just the first domino. It set off this devastating chain reaction that just ripped through India's entire financial system. This here shows you exactly how those dominoes fell. First, the war escalates and oil prices go nuts. Second, foreign investors see this, get spooked, and start pulling their money out fast. Third, that mass exodus of cash causes the Indian rupee to crash, hitting a record low. And finally, fourth, the central bank has to jump in to save the currency, which puts even more strain on the banks. It was a perfect storm. And the scale of that foreign investor exodus was just historic. We're talking about foreign institutional investors, or FIIs, dumping a staggering $12 billion of Indian stocks in March alone. Now, domestic investors, they tried to hold the line, but that tidal wave of foreign selling was just too powerful to stop. With the rupee in an absolute free fall, I mean, it broke the 95 to the dollar mark, India's central bank had to intervene. It basically ordered banks to limit their foreign exchange trading to try and curb all the speculation. And while that did help stabilize the rupee, it created a brand new problem. It added immense pressure to a banking sector that was already rocked by the market crash. So, when we pull back and connect all of these dots, the big picture becomes painfully clear.
This quote from an analyst really sums it up perfectly. Before the conflict, India's economy was in this Goldilocks state. Not too hot, not too cold. You had high growth and low inflation. This war and the oil shock that came with it just erased that stable environment almost overnight. And ultimately, this whole event really forces us to ask a fundamental question. It's a stark reminder that in our hyper-connected world, geographic distance is almost meaningless. A conflict in one corner of the globe can unleash financial chaos everywhere else, and it just shows you how fragile the system we all rely on truly is.
So that's our breakdown of how this all went down. Now, we'd love for you to join the conversation. If you found this breakdown valuable, if it helped connect some dots for you, the best way to support us is to like this explainer and share it with your network. And of course, be sure to subscribe so you don't miss our next one. But now we really want to hear from you. What was your biggest takeaway from the story of global contagion? Let us know what you think and any questions you have in the comments below. Thanks for watching.